Happy 2014, everyone! Today we will be bringing you this year's very first Dukascopy Bank Sentiment Index, where we will be reviewing the results of the December poll. Dr. Egor Matveyev from University of Alberta, Canada, has participated in the latest survey and will now provide his comments on the key findings. The first part of the sentiment that we would like to cover is the mood indicator, which is showing a positive upswing around the globe in Europe, Asia-Pacific, and North America. The mood indicator is now backed up not only by the sentiment of the survey professors, but also economic data. The manufacturing PMI in the Eurozone soared at its fastest rate in 2.5 years, while the US benefited from the strongest employment growth in 8 years and a revival in the housing market, which contributed to the highest year-end reading of the US consumer confidence since 2007. And on the other side of the world, Abenomics has proved to show the anticipated results and ameliorated confidence. However, Professor, what potential negative surprises do you see in the horizon?
So one of the few potentially negative surprises that can surface during the next year will be deflation or lower inflation rates overall in the economies. So far, we have seen the prices falling only in a few countries, for example, Greece and Latvia, but the inflation rates are generally very low, below 1%. And this is despite all the money that European Central Bank has been pumping into the economy. So if the inflation rates go down any further, this would slow down the economic growth or even worse, stop it altogether. Another potential danger of low inflation is that that will increase the real interest rates in the economy. So recall that the real interest rates are the nominal rates minus the inflation. If the inflation goes down, this would effectively make borrowing for companies more expensive and hence would lower the investment. Now, the low investment is clearly something that would be very detrimental for the economic growth right now. Now, in the political arena, there are a few dangers as well. For example, in the US political system can get paralyzed again. Now, recall that as the result of the Continuing Appropriations Act, it extended the government funding until January 15th of this year and suspended the debt ceiling until February 7th. So we're facing negotiations right now, and what exactly is going to happen there would determine what would happen in the U.S. political arena, what would happen to the U.S. debt ceiling and the budget overall. Now, there are also election cycles in some of the key emerging markets this year, for example, Brazil, India, Indonesia, South Africa, and Turkey. They all have elections in 2014. Uncertain political outcome will translate into uncertain economic policies that will add some uncertainty in investor confidence in these countries. Finally, there is a lot of uncertainty about the economic growth in China and possibility that economy may slow down. This would have adverse effects on a lot of economies throughout the world that have been increasingly relying on China. This would also adversely impact commodity markets. China right now is in need of deep structural reforms, in particular in their financial system, and a lot would depend on how they approach these problems and how this uncertainty resolves. So these four are the greatest risks that I think can surface during the next year.
Let's continue by taking a look at the economic development stages. According to the Sentiment Index poll, the overwhelming majority believe that the three key economic regions will be expanding in 3 years. However, central banks have kept the interest rates low for several years in an attempt to boost the anticipated economic growth. So, Professor, what kind of impact do you believe the inevitable increase of the interest rates would have on the economic development cycle of those regions?
I believe that in the US and North America in general, interest rates would not go up significantly. For a new Fed chairman, Janet Yellen, the goal is to keep the economy steady and only gradually raise interest rates as the economy strengthens and can take on these increases. I believe that European Central Bank in general would follow the same strategy. So I do not expect to see a lot of movement in the short-term interest rates over the next year. Now, when it comes to long-term rates, they would go up as the overall economy recovers. But I also expect these increases to be moderate, as the Fed is paying a lot of attention to these rates by buying long-term debt instruments, in particular securitized mortgages. So one of the dangers of the increasing long-term rates is that it may make long-term investment in general a lot more expensive. So some important structural investments that need to be made in the economy may not be funded. In the U.S. as well, long-term rates potentially may negatively affect housing markets, which are still very fragile. As mortgage rates go too high up, it will slow down the growth in the housing market, will slow down the home sales, decrease price gains. So this may have profound adverse effects on the overall recovery in the economy. So finally, rising rates may have adverse effects on the emerging markets as well. Now, since the long-term rates in the developed economies go back up, this would reverse the flow of funds between the countries, and the capital from the emerging markets would go back to the developed countries. This capital outflow would not only significantly hit the local currencies in the emerging markets, it will also dry out the liquidity in these markets, which would adversely affect investments in these markets. But the good news is that the Fed has been warning of this tapering for quite some time now, so the central banks in these emerging markets had enough time to come up with measures that will counteract this reverse flow of capital.
And to finish, the concluding graph highlights how the economic sentiment grew from August to December, showing a positive move up. But how do you see the trend evolving in the next 5 months, and what will be the key drivers behind it?
I believe that the sentiment in general may go slightly up over the next 5 months or remain flat. One of the reasons is that more than 90% of the responders believe that North America and Asia go through the expansion phase of the business cycle right now, or are at the business peak. So in general, it will be hard to beat these numbers over the next 5 months, since there is still enough uncertainty. So the sentiment for North America and Asia in general may remain flat or go slightly up. Now, when it comes to Europe, I believe that the sentiment will definitely go up, but of course it will depend on how successful the European Central Bank is at implementing their policies. And overall, the developments of the sentiment will depend on the policies of the Fed and ECB and the resolution of the political uncertainty around the world.
That brings us to the end of today's Sentiment Index. Dr. Matveyev, thank you for taking part, and thanks to our viewers for watching. We hope you found the information useful. And don't forget that a more detailed analysis of the Dukascopy Bank Sentiment Index is available online by going to Dukascopy.com and clicking on Sentiment Index under the Market Research section. See you next time. Goodbye.